Your mortgage rate just hit 7%. You're blaming the Fed. Your financial advisor is blaming inflation. The news is blaming tariffs. And every single one of them is looking at the wrong thing. The real reason borrowing in America is getting more expensive is happening 6,000 miles away in a country most investors haven't thought about in years. And once you see it, you can't unsee it. Japan is the single largest foreign holder of U.S. government debt. Not China, Japan. As of October 2025, Japan holds approximately $1.14 trillion in U.S. Treasury securities, money that has been flowing into America for 3 decades, keeping your mortgage rates artificially low and your stock valuations artificially high. How did this happen? After Japan's massive real estate and stock bubble collapsed in 1992, the Bank of Japan did something radical. They set interest rates to essentially zero for 30 years. When your home market pays you nothing, you send your money abroad. The classic carry trade structure involved borrowing yen at roughly 1% to earn around 4% on U.S. Treasury bonds, a theoretical 3% spread annually. Estimates put the size of the Japanese carry trade at least $500 billion. That is $500 billion propping up American asset prices, and it's now reversing. Now, you might be thinking, Raj, I watch the Fed. When the Fed cuts rates, mortgages go down. Simple. Here's the thing. That's only half the picture. The Fed controls short-term rates, but your 30-year mortgage is tied to the 10-year Treasury yield, and that yield is set by the global market, which means Japan has enormous power over your monthly payment. Think of it like a stadium. The Fed controls the PA system, but Japan has been quietly filling 20,000 seats every single game for 30 years. When those seats empty, the noise drops, and the cost of putting on the game skyrockets. The Bank of Japan ended its yield curve control in 2024 and has been normalizing policy ever since. The BOJ lifted rates to 0.75% in December 2024, a 30-year high. Since the start of 2026, both the 10-year and 30-year Japanese government bond yields have jumped 100 basis points, hitting their highest levels in 20 years. When Japanese bonds actually pay a return, there is zero reason for Japanese capital to sit in America. Japan's net external assets hit an all-time high in 2024 at 533 trillion yen. That's $3.7 trillion sitting outside Japan's borders. Even a partial repatriation of that capital pulls a massive buyer out of the U.S. Treasury market. And here's the kicker. This comes at the exact moment the U.S. government is running a budget deficit of approximately $2 trillion annually. You need more buyers right now. You're about to have fewer.
Strategists have warned this could trigger a loud sucking sound in U.S. financial assets. Higher long-term yields, even if the Fed is cutting short-term rates, tighter corporate credit, and lower stock valuations. And the August 2024 preview? The NASDAQ 100 fell 13% in under a month as investors unwound yen-funded positions. Analysts at Natixis are saying the full unwind will be worse than August 2024. You can't stop this. But you can position ahead of it. If long-term Treasury yields keep rising regardless of Fed policy, that means rate-sensitive assets, long-duration bonds, highly leveraged real estate, growth stocks trading at 40 times earnings are the most exposed. Meanwhile, shorter duration assets, commodities, and international diversification become more relevant than they've been in a decade. You don't need to panic. You need to rebalance with your eyes open. Here's your 3-step action plan for this week. Step 1. Look at your portfolio and identify anything that is deeply sensitive to rising long-term rates. That means long bond ETFs like TLT or highly leveraged REITs. Step 2. Check what percentage of your holdings are U.S. only. If the answer is 90% or more, that's a concentration risk you should discuss with a financial advisor. Step 3. Search TIC Data Japan. That's the U.S. Treasury's monthly report on foreign bond flows. When Japan goes from buyer to seller, you'll see it there first before any headline. 5 years from now, you'll either be the person who understood that global capital flows shape your financial life, or the person who kept blaming the Fed while the real story played out in Tokyo.
The investors winning over the next decade aren't the ones with the hottest stock tips. They're the ones who understood the architecture of money before the building started shaking. The information is all public. It's just not packaged for people like you, until now. If this gave you one thing to think about that you weren't thinking about yesterday, smash that like button, subscribe, and tell me in the comments